In today's video, I want to show you a simple example of a trend continuation trade using the idea of hyper-integration. In my last video, I talked about different kinds of integration and how a high-quality trade opportunity starts with the simple signal of a non-lagging trade technique, and then the process of integration begins to verify the validity of that first idea. In this trade example, the idea that jumpstarts the analysis is a simple dynamic frequency breakout, which happens all the time. In this case, we are looking at a dynamic frequency breakout from a downward price vector to a possible upward price vector. If you don't know what a dynamic frequency breakout is, you can learn that in my Price Action Trading Volume 1 course. This little breakout by itself suggests that price might go up from here, but remember that this is just one signal in isolation. Price could very well continue going down. Let's now develop the analysis to see if you can justify the signal from the dynamic frequency breakout using the principle of integration. Instead of using the RSI, which doesn't yield any confirmation in this scenario by the way, I want to use a numerical volume indicator called cumulative volume delta. This indicator plots the sum of the difference between the bull and bear volume in each period. It shows a different perspective in comparison to the volume histogram, for example. In the CVD, we can see a continuation pattern since price is currently making a higher low while the CVD is making a lower low. This is called a downtrend absorption because there is volume to the downside, but that is not reflected in price action. In even clearer terms, there's a lot of selling volume, but buyers are simply not letting price go to the downside, meaning that they are absorbing the supply. That in itself is a strong sign that price might go to the upside from here. In a way, it's as if the dynamic frequency breakout confirmed the downtrend absorption shown by the cumulative volume delta. Another cool perspective we can add here, still in terms of volume analysis, is through the anchored VWAP indicator. If we plot the VWAP on a major low, we'll see that price is currently finding support in the main VWAP line. It broke the dynamic frequency of the last downward price vector after touching the VWAP line 4 times without violating it. Notice that we integrated 2 volume analysis techniques to the original dynamic frequency breakout idea. Let's erase the volume analysis and move on to other perspectives. In terms of pitchforks, there are a couple of things we can notice in here. In this chart, you can see I plotted a pendulum pitchfork using major price extremes. The interesting thing about this fork is that price respects it almost perfectly 2 times before our current area of interest. It hits the median line and then reverses to hit the upper line. This shows that this fork was indeed catching the frequency of the market, but right now it's failing to do so if we assume that price will go to the upside from here. In pitchfork analysis, this is called a Hagopian's rule. When price fails to meet a pitchfork line that has been tested, it tends to produce a strong reaction to the opposite side, which is something that adds strength to our analysis. There is another good pitchfork we can draw in here, which is a modified shift one. Notice that this one also does its job of projecting a price extreme at the median line, and now the current area of our interest is falling exactly at the lower line of this modified shift pitchfork. Observe that the more techniques we add here to confirm the initial idea, the greater the probability that all of this is not merely a coincidence. We integrated 2 pitchfork perspectives into the analysis we had in terms of volume. Let's erase the chart once again and observe this market from another point of view. In terms of phase analysis, there are a few good insights we can get in this market. Perhaps the simplest of all comes from the Dow theory. We can notice that price is producing higher highs and higher lows, which is the best definition of uptrend you'll ever going to find in technical analysis. Even though the last high didn't surpass the previous one, the notion of uptrend is still intact until this point. Another interesting detail here, which is a little more subtle, is the presence of a bear trap in the minor flow. The blue horizontal line shows the origin of a breakout to the downside that quickly turned against the minor sellers that trusted it. It seems that the market has a short-term memory that will remember this sort of traumatic event. Recall that a bear trap is when sellers are induced to the downside through a breakout of a low in order to generate liquidity. That liquidity is used by large traders to enter the market to the upside. The market is at the price level where the bear trap occurred right now. Those sellers that got frustrated in the bear trap are now eager to buy. Notice that we can add this layer of the bear trap in a minor flow with the overall uptrend defined in terms of the Dow theory. The two ideas converge perfectly in this case. In terms of Elliott wave, there are wave counts that would confirm the original idea, but there are wave counts that wouldn't, so I will leave that aside. Before wrapping this up, I want to show you one more technique, although we can probably spend 1 hour talking about what's happening in here. If we plot a linear regression channel from one major low to the current low, which is potentially a major low also, we'll see that the angular coefficient of the regression allows us to draw a parallel line that points to the current area of interest if we plot this parallel line in the same low that originates the linear regression channel. In summary, the analysis began because the dynamic frequency breakout brought the attention to a specific price level at a specific point in time. From that initial spark, we've tried to justify the original idea by integrating different kinds of techniques: the downtrend absorption outlined by the cumulative volume delta and the dynamic support provided by the anchored VWAP line. We also looked at a couple of pitchfork ideas, Dow theory, and a bear trap in a minor flow. To conclude, we also looked at the linear regression channel. We could enter a long trade at the open of the next candle in here, and a logical stop loss order would be right below the bear trap, for example. The target should be at least 3 times larger than the stop loss for reasons that go outside the scope of this video. Let's see how the market developed after that. Here you can see that the area of interest was indeed a major turning point in the market. What I want you to understand from this video is that when you use the idea of hyperintegration, the probability that you will generate a high-quality trade by accident decreases as the level of integration increases. That is the best way of filtering trade opportunities. If you have the patience to act only when non-lagging trade techniques converge like this, there is no doubt that you will become consistently profitable, minimizing your risk and maximizing your profit potential. If this wasn't a high probability trade, it would be difficult to justify the entry point with good techniques. That's how you can tell the difference between a good trade and a bad trade. The effort of trying to justify the trade is overlaid by the logical constraint of the non-lagging trading techniques, and that makes this effort worthwhile instead of turning it into a mere representation of confirmation bias. That's it for this video. If you want to learn professional trading techniques, check out my premium courses and ebooks in the video description, or send me an email at support@fractalflowpro.com. If you like the material I create in this channel, please support it by clicking the like button, subscribing to the channel, activating all notifications, leaving your comment below, and sharing the video. Thank you very much for watching, and I hope to see you in the next videos. Take care.